Welcome to Accounting Made Easy course. In this course, you are going to learn accounting only with 15 real-life example or real-life transactions. Accounting can indeed be complex, but here are some simplified steps to help make it easier to understand. First, understanding the basics. Familiarize yourself with fundamental accounting concepts like assets, liabilities, equity, revenue, and expenses. Second, set up your chart of accounts. Create categories to organize your financial transactions such as assets, liabilities, equity, revenue, and expenses. Each category will have various accounts to track specific types of transactions. Third, record transactions. Record each financial transaction in the appropriate account using the journal entries. For example, when you make a sale, record the revenue in the revenue account. Fourth, prepare financial statements. Regularly generate financial statements, such as the income statement shows revenue and expenses over a period. Balance sheet provides a snapshot of assets, liabilities, and equity at a specific point in time. And cash flow statement tracks cash inflows and outflows. Muhammad had always dreamed of making his own company. He embarked on a journey to start his own company. Muhammad founded Alid Brothers. This company deals in food supplies. First transaction. The owner injected startup capital into his company. The owner has contributed funds to finance the startup phase of his business. The fund invested by the owner in the business or the net amount claimable by the owner from the business is known as the capital or owner's equity or net worth. Second transaction. Alid Brothers is a general food trading company specializing in the purchase and sale of various food products. Alid Brothers will use the owner's investment to procure food products and cover associated expenses. A cash purchase refers to a transaction where goods or services are bought and paid for outright with cash as opposed to credit or financing. In a cash purchase, the buyer pays the full amount upfront at the time of the transaction, and ownership of the purchased item is transferred immediately. This method of payment is straightforward and does not involve any debt or interest charges since no borrowing is involved. Cash purchases are common in everyday transactions. Alid Brothers purchases food products and makes immediate cash payments at the time of transaction. Third transaction. Cash sales refer to transactions where goods or services are sold and payment is made immediately in cash at the time of the sale. In a cash sale, the buyer provides the seller with cash and the seller transfers ownership of the goods or services right away. This type of transaction is straightforward and does not involve credit or delayed payment terms. Cash sales are common in retail settings such as stores and markets, as well as in various service industries where payment is made directly upon receiving the service. Alid Brothers conducts cash sales of goods. Now you will learn the gross profit. What is gross profit? Gross profit is the difference between a company's sales and the cost of goods sold. It represents the amount of money a company earns from its core business activities after deducting the direct costs associated with producing or purchasing the goods sold. The formula for gross profit is: gross profit is equal to revenue minus cost of goods sold. First, revenue. This is the total income generated from selling goods. Second, cost of goods sold. This is the direct cost incurred in purchasing the goods that were sold during a specific period. It includes the cost of products. By subtracting the cost of goods sold from the revenue, you arrive at the gross profit. Transactions number 4. Paying salary transaction. In accounting, expenses refer to the costs incurred by a business in its day-to-day operations to generate revenue. Expenses are essential for running a business and are subtracted from revenue to calculate net income. Operating expenses, these are the expenses incurred in the normal course of business operations that are not directly tied to the production of goods. Operating expenses include items such as rent, utilities, salaries, marketing and advertising costs, office supplies, insurance, and depreciation. Expenses are recorded on the income statement and are subtracted from revenue to calculate net income or net loss. Managing expenses effectively is crucial for maintaining profitability and financial stability in a business. Allied Brothers disbursed employee salaries in cash. Allied Brothers paid its employees' salary by cash. You will learn how to book the cash salary in the accounting software. Now, you will learn about net profit. Net profit, also known as net income or net earnings, is the amount of money a company has left over after subtracting all expenses from its total revenue. It represents the profit generated by the business after accounting for all costs and taxes. The formula for net profit is: net profit is equal to total revenue minus total expenses. Total revenue, this is the total income generated by the company from its primary business activities, including sales of goods or services. Total expenses, these are all the costs incurred by the company in its operations, including the cost of goods sold, operating expenses, interest expenses, taxes, and any other relevant expenses. Net profit is a key measure of a company's profitability and financial performance. It indicates how efficiently the company is managing its operations and generating profit from its core activities. Net profit is often used by investors, analysts, and stakeholders to evaluate the overall health and viability of a business. Transaction number 5. Credit purchase. A credit purchase refers to a transaction where goods or services are acquired by a buyer on credit, meaning that payment is not made immediately at the time of purchase but is deferred to a later date. In a credit purchase, Allied Brothers receives the goods or services from the seller. Instead of paying cash upfront, Allied Brothers agrees to pay the seller at a later date according to agreed upon terms. The seller extends credit to the buyer, effectively allowing them to obtain the goods or services on loan. Credit purchases are common in various business-to-business transactions and can be beneficial for managing cash flow, allowing buyers to acquire necessary goods or services without immediate payment. Transaction number 6. Credit sales. Credit sales refer to transactions where goods or services are sold to customers on credit, meaning that payment is not received immediately but is instead deferred to a later date. In a credit sale, the seller delivers the goods or provides the services to the customer. Instead of receiving payment upfront, the seller extends credit to the customer, allowing them to make payment at a later date according to agreed upon terms. The customer agrees to pay the seller within a specified period, typically outlined in the terms of the credit agreement. The seller records the sale as revenue in their accounting records at the time of the sale, even though payment has not been received. Credit sales are common in various industries, including retail, wholesale, and services, and can be beneficial for attracting customers and increasing sales volume. However, they also carry the risk of non-payment or delayed payment, which can impact the seller's cash flow and financial stability. In this example, Allied Brothers is the seller. Allied Brothers sell the goods to the customer in credit. Customer will pay the payment later as per the agreed terms. Transaction number 7. Cash sales return. A cash sales return occurs when a customer returns goods for which they made a cash payment at the time of purchase. This transaction involves the reversal of the original cash sale and typically results in a refund to the customer. Customer returns goods. The customer returns the purchased goods to the seller, citing reasons such as defects, dissatisfaction, or incorrect items. Processing the return, the seller verifies the returned goods to ensure they are in their original condition and eligible for return according to the company's return policy. Refund. If the return is approved, the seller provides a refund to the customer in the form of cash or issues a credit memo if the customer prefers to apply the refund to future purchases. Recording the transaction in the seller's accounting records, the cash sales return is recorded as a decrease in sales revenue and an increase in sales returns or refunds issued. In this example, customer will return the goods to the seller, Allied Brothers. Allied Brothers will return the cash to the customers. Transaction number 8. Cash purchase return. A cash purchase return, also known as a cash refund or cash return, occurs when a buyer returns goods to a seller for which they made a cash payment at the time of purchase. This transaction involves the reversal of the original cash purchase and typically results in the return of the purchase price to the buyer. Buyer returns goods. The buyer returns the purchased goods to the seller, citing reasons such as defects, dissatisfaction, or incorrect items. Verification of returned goods. The seller verifies the returned goods to ensure they are in their original condition and eligible for return according to the company's return policy. Refund issued. If the return is approved, the seller provides a refund to the buyer in the form of cash. In this example, Allied Brothers will return the goods to the supplier. Allied Brothers will receive the cash from the product supplier. Transaction number 9. Credit sales return. A credit sales return, also known as a sales return, occurs when a customer returns goods for which they were originally invoiced on credit. In other words, the customer purchased goods on credit terms and is now returning them for various reasons such as defects, dissatisfaction, or incorrect items. Customer returns goods. The customer returns the purchased goods to the seller, providing reasons for the return. Verification of returned goods. The seller verifies the returned goods to ensure they are in their original condition and eligible for return according to the company's return policy. Issuing a credit memo. If the return is approved, the seller issues a credit memo to the customer. A credit memo is a document that reduces the customer's accounts receivable balance by the value of the returned goods. Credit sales returns are an integral part of the sales process as they allow customers to rectify issues with purchases and help maintain customer satisfaction. Transaction number 10. Credit purchase return. A credit purchase return, also known as a purchase return, occurs when a buyer returns goods to a seller for which they were originally invoiced on credit terms. In other words, the buyer, Allied Brothers, acquired goods on credit and is now returning them for various reasons such as defects, dissatisfaction, or incorrect items. Buyer returns goods. The buyer returns the purchased goods to the seller, providing reasons for the return. Verification of returned goods. The seller verifies the returned goods to ensure they are in their original condition and eligible for return according to the company's return policy. Issuing a credit memo. If the return is approved, the seller issues a credit memo to the buyer. A credit memo is a document that reduces the buyer's accounts payable balance by the value of the returned goods. Credit purchase returns are an essential part of the purchasing process, as they allow buyers to rectify issues with purchases and help maintain good relationships with suppliers. Transaction number 11. A loan taken from a bank for a company refers to funds acquired by a company from a bank with the agreement to repay the borrowed amount along with interest and any other applicable fees over a specified period. Loan amount. The loan amount represents the principal sum of money borrowed by the company from the bank. The loan amount is typically determined based on the company's financial needs, creditworthiness, and the purpose of the loan. Taking a loan from a bank can provide companies with the necessary funds to finance business expansion, purchase assets, manage cash flow, or meet other financial needs. However, it's crucial for companies to carefully assess their borrowing needs, review loan terms and conditions, and ensure they can meet their repayment obligations to avoid financial difficulties. You will learn how to post loan transaction in journal entry. Transaction number 12. Loan repayment in a company refers to the process of returning borrowed funds to the bank according to the terms of the loan agreement. When a company borrows money from a bank, it agrees to repay the borrowed amount along with any accrued interest and fees over a specified period. Scheduled payments. The company makes periodic payments to the bank according to the agreed upon repayment schedule. Payments may be made monthly, quarterly, annually, or according to another agreed upon frequency. Loan repayment is a critical aspect of managing a company's finances, and it's essential for companies to budget effectively and plan for loan repayments to ensure they can meet their financial obligations and maintain healthy cash flow. You will learn the loan repayment journal entry. Transaction number 13. A sales discount is the reduction in the price of goods or services offered by a seller to a buyer as an incentive to prompt payment or to encourage larger purchases. It is a common strategy used by businesses to attract customers, accelerate cash flow, and increase sales volume. Sales discounts are typically expressed as a percentage of the total invoice amount. Offering a sales discount reduces the amount of revenue recognized by the seller for the sale. For example, if a $100 item is sold with a 2% discount, the seller only recognizes $98 in revenue. Overall, sales discounts can be an effective tool for businesses to stimulate sales, improve cash flow, and maintain positive relationships with customers. You will learn sales discount entry. Transaction number 14. A purchase discount, also known as a trade discount or an early payment discount, is a reduction in the price of goods or services offered by a supplier to a buyer as an incentive for prompt payment or for purchasing in larger quantities. Purchase discounts are typically expressed as a percentage of the total invoice amount or as a specific dollar amount. Taking advantage of a purchase discount reduces the cost of goods or services purchased by the buyer. For example, if a $100 item is purchased with a 2% discount, the buyer only pays $98. Overall, Purchase discounts can be a beneficial tool for buyers to reduce costs and for suppliers to improve cash flow. Transaction number 15. Salary payable refers to the amount of money that a company owes to its employees for work performed during a specific period but has not yet been paid. It represents the liability that the company has to its employees for their earned wages. Accrual accounting. In accrual accounting, expenses are recognized when they are incurred regardless of when cash is actually paid. This means that even if employees have not yet been paid, their earned wages are recorded as an expense and a liability in the company's financial records. Salary payable is an important aspect of a company's financial management as it represents an obligation that the company must fulfill. What is balance sheet? A balance sheet is one of the three primary financial statements used to assess the financial health and position of a company at a specific point in time. The other two financial statements are the income statement and the cash flow statement. The balance sheet provides a snapshot of a company's assets, liabilities, and shareholders' equity at a particular date, typically the end of a reporting period, such as a quarter or fiscal year. Assets. Assets represent what a company owns or controls and can include both tangible and intangible items. Tangible assets may include cash, inventory, property, plant, and equipment, while intangible assets may include patents, trademarks, and goodwill. Assets are typically listed on the balance sheet. Liabilities. Liabilities represent what a company owes to external parties, including creditors, suppliers, and lenders. Liabilities can include accounts payable, loans, bonds, and other obligations. Like assets, liabilities are typically listed on the balance sheet in order of maturity, with short-term liabilities due within 1 year listed before long-term liabilities due after 1 year. Shareholders' equity. Shareholders' equity, also known as owner's equity or net worth. Shareholders' equity may consist of various components, including common stock, retained earnings, and additional paid-in capital. The balance sheet follows the fundamental accounting equation. Equity is equal to assets minus liabilities. This equation must always balance, ensuring that a company's assets are financed by either borrowing, liabilities, or ownership, shareholders' equity. The balance sheet provides valuable insights into a company's financial position. An income statement, also known as a profit and loss statement or P&L statement, is one of the three primary financial statements used to assess the financial performance of a company over a specific period of time, typically a quarter or fiscal year. The other two primary financial statements are the balance sheet and the cash flow statement. The income statement provides a summary of a company's revenues, expenses, gains, and losses during the reporting period and calculates the net income or net loss generated by the company's operations. It helps stakeholders understand how much money a company made or lost from its core business activities. Revenues, also known as sales or turnover, represent the total income generated by a company from its primary business operations. This includes revenue from the sale of goods or services, interest income, rental income, and any other sources of operating revenue. The cost of goods sold represents the direct costs incurred by a company in producing or purchasing the goods sold during the reporting period. Gross profit is calculated by subtracting the cost of goods sold from total revenue. It represents the profit generated by a company's core business activities before deducting operating expenses. Operating expenses are the costs incurred by a company in running its day-to-day operations. This includes expenses such as salaries and wages, rent, utilities, marketing, depreciation, and administrative expenses. Net income is the bottom line profit or loss of a company after accounting for all revenues, expenses, gains, and losses during the reporting period. The income statement provides valuable insights into a company's profitability, efficiency, and financial performance over time. It is used by investors, creditors, analysts, and other stakeholders to evaluate a company's ability to generate profits, manage expenses, and create value for shareholders. What is journal entry? A journal entry is a record of a financial transaction in a company's accounting system. It documents the effects of the transaction on the company's accounts by recording the corresponding debits and credits. Journal entries are the building blocks of the double entry accounting system, which ensures that every transaction has equal debits and credits to maintain the accounting equation's balance. The first step in creating a journal entry is to identify the transaction that occurred. This could be a sale of goods, purchase of inventory, payment of expenses, receipt of revenue, or any other financial activity. Journal entries are essential for maintaining accurate and reliable financial records, tracking transactions, and ensuring compliance with accounting principles and regulations. They provide a detailed audit trail of a company's financial activities, allowing for transparency, accountability, and effective decision-making. What is trial balance? A trial balance is a list of all the general ledger account balances of a company at a specific point in time, typically at the end of an accounting period such as a month, quarter, or fiscal year. The purpose of the trial balance is to ensure that the total debits equal the total credits in the company's accounting records, thereby verifying that the accounting equation remains in balance. The trial balance includes a list of all the general ledger accounts used by the company, such as assets, liabilities, equity, revenues, and expenses. For each account listed, the trial balance shows the balance or total of all the transactions recorded in that account up to the specified date. The balance is typically broken down into debit and credit columns. Debit balances are listed in one column and credit balances are listed in another column. The total of the debit column should equal the total of the credit column. If the trial balance does not balance, if the total debits do not equal the total credits, it may indicate errors in the accounting records, such as posting mistakes, transposition errors, or incorrect account classifications. The trial balance can help identify and correct these errors before preparing financial statements. The trial balance is an essential tool for ensuring the overall accuracy and integrity of a company's financial records.